how does one start? How does one find themselves in this space? And does this become somewhat of an avenue, of growth where wealth creation is concerned, where you can say, if you start here and you pace yourself and maybe you give yourself time, you do the work, maybe in a couple of years' time, you can find yourself in that Boba space that I was talking about earlier on. How does one actually get into this space of property investing?
When we're preparing on this one, right, it's really interesting when it comes to property investing that there's different portfolios or avenues that a beginner can start with, right? Because you're looking at REITs, property REITs, you're looking at real estate investment trusts. So in that way, what's happening there is more of, as a beginner, one is investing in a real estate trust whereby it's already established by people that know how that operates. So it's more of you buying shares, right? So with that one, there's little to none experience that is needed from a beginner's perspective, right? But then now you get to other spaces whereby there's crowdfunding. So when we're talking about crowdfunding, we're talking about a group of people coming together to purchase for a common goal. So this could be that 5 years or 10-year plan. It's totally up to the leaders, right? However, there's also that other option whereby you are the property investor, you identifying the property and you're on the ground. And for me, that is the space that I really enjoy, because literally you understand the skill and this is a skill that you can also give on to future generations.
So they're different, ways of going about it, but all of them, I guess, would be what you investing in property, in the property space, and you then finding your way around this space, be it through crowdfunding, be it through a trust of some sort, but they're all meant to what? To make you an investor in this space and a player. How does one define it? How does one define property investing? Is it a matter of you buying this property and then selling it? Is it a matter of you buying this property, renting it out? Is it a matter of you maybe buying this property, staying in it for maybe legacy wise, in terms of it being somewhat of an asset for future generations, in terms of my kids and maybe my kids? We know that this is a family home. So there, I guess, different ways to then go about it in a way that at the end of the day, you still call yourself a property investor.
Yeah. So for me, Katlehona, I just want to make it clear, because I know a lot of people will fight about this, right? Investing for me is something whereby I'm going to be putting in money and seeing the rewards from that property. Right? So now, if I'm investing in a property that I'm going to be living in, for me, it doesn't make business sense, because if I'm going to be looking at should I need to sell the property in the near future, then I will be in a position whereby I might actually lose a lot of money. Right? So I'll give you a classic example. So someone buys a property that's worth 1.7 million. Then 5 years down the line or 7 years down the line, they're expecting to sell the property for 2.7 million. And chances are it won't work like that if you haven't actually added any value onto the property. Now, if you want to sell your property, or you at a position that you want to sell your property and the market value of the property was 1.7 million, it becomes hard for you to actually get that interest that you thought would be there once you actually sell the property.
Because the market is standardized to say you can't go 2.8 million. This is the range that the properties around this area would go for.
100%. So if we are saying that something is an investment, there has to be some sort of system that you are following in order for you to buy that specific property. Right? So say for instance, if I'm saying that I buy my properties below market value and I'm buying them at 70%. So if the property is worth 1 million, I'm buying it at 700,000. I already know that should I want to sell the property, then it will actually be an investment. So from my perspective, an investment, it only becomes an investment once we have some sort of system that we can tap into to make sure that we will actually be getting some sort of an income from this property, be it when we sell it or when we do rent it out. So some people will buy properties, fix them up and then resell them. right? And then some people will buy the property only to rent it out. So now when you're looking at those two main strategies, that's when we can say that, okay, this person is a player in the property investing game. But the guys that are buying properties to live in, most of them, they're buying it at market value. So personally, I wouldn't call that an investment, because the dividends that you're going to be getting at the end of when you do sell the property, we don't know how to actually gauge that.
Which one, brings you closer to amassing this wealth? Does it become the buying to, more or less fix and sell, or buying to rent it out over time? Which one then would you say would be advisable for someone that is looking at this space and they're like, I want to be a property investor?
Once you follow the guidelines that Lebu mentioned that tell us that we should be buying a property, you as an investor should understand two options, right? It's either your main goal is cash flow or your main goal is capital gains. So what do I mean by saying cash flow and capital gains? Someone will then say that, you know what, within my journey, I would like to be collecting, let's just say that 20,000 on a monthly basis. So then rental would then be your approach. Whereas someone would rather say that within 5 years, I would maybe let's say to buy a truck cash. Let's just say it's at about 800,000. Now that person will be looking at flipping properties. So it's very important that we understand why are we in the game. So that will then inform the strategy that you need to be following, because unfortunately it will happen sometimes whereby you're like, I want to stop my job, but then if you are too focused on capital gains, it's still risky, because now you'll be having expenses from month to month, whereas it might rather tell you that, yes, I like renting out, but my situation wants me to flip. So it depends on one's situation.
Just a reminder to our listeners at home that we have Lebo and Neo here in studio. They're coming through really with all of this wisdom around property investing, and would like you to form part of this conversation this morning. If you have questions, you're welcome to share. If you have comments as well, you're welcome to also join in this morning. Let's try to really get ourselves closer to this wealth in terms of the property space, and it will be interesting to get a sense of whether it becomes favorable when you had approached the bank to go about it through the bank, or you basically there are other alternatives in terms of how you can then form part of this space. I mean, not everyone would have capital ready to go, and you want to maneuver and the likes. Where does one start, and how does one actually get into this space? Can a 9-to-5er become an investor?
Yeah.
Looking at the salary that you get at the end of the month, can it also help push you into that space of property investing?
Yeah. So most of the time we like saying we need our money to work for us. Now, Neo was also saying that we also need our credit to work for us. Now, most of the time we hear people saying that, no, it's going to affect your credit score, it's going to do this. Now, we need to understand that if I'm working, I have a pay slip, I have 3 months bank statement. And if I do have a good credit score, I am able to actually buy my properties with credit, right? Now, the thing that I really want to stress is that if you are going to be buying a property, when you buy it cash, it has a little bit of grace, because the biggest expense that you do have when you are buying a property becomes your bond. Now, if you're buying via credit and you don't know what you're doing, you might find yourself in a situation whereby now you're needing to take out money on a monthly basis to make sure that all of your expenses are actually balanced. But now, if you're going via the cash route, you don't have that expense bond, so it doesn't become that much of a big deal. So what I would say is that before you even purchase your first property, let's understand what kind of properties should we actually be buying, at what price should we be buying that properties. Then at least that will guide us that how much should we actually be spending on the property.
And can you maybe supplement whatever you're getting from the bank? Let's say you have maybe a little bit of funds saved up, and then you want to go into this space, you want to maybe buy a property. but you don't have the entire cash. Can the bank come through for you in terms of helping you here? Does that position you and put you in a bit of a favorable space when you're going to knock, this banks and how does that help you?
100%. So a lot of beginner property investors would then, let's just say that I'm getting 100% bond, right? They would rather be like, you know what, I got 100%. There's no need to put any money down, especially looking at it from a rental perspective. But look at it this way, right? Lebo, as someone who's renting out the property, he tries to at least put down at least 30%. I'll tell you why. So let's look at a property worth 1 million that'd be bought for 1 million, and then he's pushing to put down 300,000. So essentially then the loan is 700,000. So ultimately, if he's at an interest rate of about 10.5%, let's just say that he's paying for that deposit that he put down, he's rather paying about 7,500. Whereas the guy that took the 1 million full and didn't put down the deposit, he's then paying back on a monthly basis 10,500 for the same property. So where the problem becomes is that, let's say we are both collecting 11,000 from that property. So if you didn't put down any deposit, ultimately means that you are paying higher and therefore your cash flow is less. And remember something right now, is that if my cash flow is less, that means that my affordability is less to buy the next property. So ultimately it does catch up to you when it comes to scaling.
So you're working at a loss in a way, because it doesn't help you in the near future. But also at the same time, and this is something that I picked up, I saw it online. Everyone now is like, that's why we bring you guys in here in studio so you can help us here. Because now we were talking technology earlier on with Chloe. Everyone can go and be an expert around some of these things, which is why it's advisable to really go to reputable people like your known wealth when you want advice around some of these things. But really, when you look at it, there was someone that was mentioning, I think they said it's capital adjustment or something like that, which is where you don't really then fully disclose to the bank that you've got the monies, to purchase, or you've got like a deposit for this property. You push for them to give you somewhat of 100% a bond, and then you put somewhat of a payment after 3 deductions. And they were saying that would then put you in a bit of a better position. I don't know if it, it affects, your rates, or how it tends to put you in a better position. But they were saying that, it doesn't help when you go to the bank and you disclose that I have, because the bank would still want to, in any way, be in the favorable space where they take from you, that you only disclose and put this payment after 3 deductions or 2 installments. What is the capital reduction? What is it called?
I'm familiar with that strategy, right?
Yeah.
And I think I had a conversation with one of the bond originators.
Sure.
So bond originator would be someone that will apply on your behalf in terms of getting a loan. So now, the thing about banks and how the negotiations have to take place. Now, I think a lot of people, how they go about it is that they go to their bank and then they apply with their bank. Then it doesn't give the bank the competition in order for you to get the best interest rates, right? And now something that we also need to understand is that if I'm going to a bank and I'm taking out my bond right now, if my interest rate is calculated at 10.5%, it's going to be based on the risk that the bank is actually willing to take with you, right? Now, if I'm coming through 2 months later and putting down that big deposit, at 2 months, the bank doesn't have enough information about you in terms of what kind of payer are you. So now it then becomes tough for the bank to say that let's renegotiate the interest rate. However, if we are saying that, Mr. Bank, how much are you willing to give me? And then they are saying that, okay, based on your profile, I'm willing to give you, say for instance, you have to put down a deposit. You don't have to put down a deposit. We're giving you 100%, but now the interest rate is at 11%. Now, if we go back to the bank and say that I'm willing to put down a deposit at 20%, what interest rate can you actually give me? Then they're able to actually work out that interest rate in the beginning so that we lock you in, let's say at 10.5%. So that becomes the better route of doing it in terms of being upfront from the beginning, then negotiating the interest rate so that once it's locked in, after 5 years, we can go back and say that can review the interest rate. Because now after 2 months, you can't renegotiate your interest rate because now you've put in a bigger deposit.
So it can be a strategy, but take time for the bank to get to know you.
Yes.
And to get to really pick up on the patterns.
Yes.
In terms of how you are, if you are a risky person or not.
Yes.
But can it take you all the way down? Like your interest rate, can you renegotiate it all the way down? Because now you have half of what you were supposed to pay in 20 years.
Yeah.
You are like, I have half. I can pay it now, and then we cut the 20 to 10, for instance. So is that how you really then go about it? How does it work?
Okay. So remember, whenever you are negotiating on your interest rate, if it's after 2 months, it becomes hard for you to negotiate with the bank, right? Because we don't have that relationship between yourself and I. That's why you'll find other people saying that I have 1 million in the bank, but the bank still won't give me the loan. Because you don't have that relationship with the bank, or you don't have a credit score, right? So how I would say that would be the best way to go about it is to find a bond originator. So bond originators, every day, their daily job is to negotiate with banks. So you get that person in your team, you tell them upfront that I have so much in money in terms of putting down a deposit, and then they will actually find the best interest rate for you. Personally, I feel like that's the best way to actually go about negotiating with the banks.
And can we please read the T's and C's when it comes to negotiation? Because someone did get a lower interest only to find out that the loan term increased. So when you're looking at the repayment again, it was sky high again. So the question was it worth it? So it's not worth it.
Yeah, because now it's like you're still, it can be 30 years, 20 years, and it doesn't come through to help you. Is there a difference between credit versus debt in property?
Okay.
In property finance, like the credit versus debt, is it a matter of saying that how the bank would categorize it in line with where you are, maybe with your score, or how do you actually approach this?
Okay. So when it comes to credit, right, remember that the debt that we're owing with also other debtors, right, the people that are borrowing money, that will be taken into consideration in order to calculating the score. So once they understand in terms of how much are we owing as a whole, that's when they're able to tell us that this is how much you owe. In terms of when we first apply for that home loan, they do not necessarily give us that credit score, the percentage that we'll be paying, right? Until
pre-approval,
when it comes to pre-approval, only once we've signed everything and then we're saying that we want to buy this, that's when they will then tell you that this is your pre-approval, this is your credit score.
And also just to jump on that, right, the reason why they do that is that your interest rate, your credit score could change, right? So some people do a pre-approval right now only to buy the property 6 months later. So they don't know how your credit behavior would be within that time. So hence they'll only give you the interest rate once you actually have an offer to purchase that is signed to say that, okay, you want to buy a property for 1 million, this is the interest rate that we're going to give you.
I see. And also at the same time, in terms of the terms, it goes with how you would want it, right? In terms of how you would want to settle the payment. Either it becomes a 20-year, a 30-year. It depends on how you are negotiating. I see. And how do you know when is the favorable time to buy property? If you are someone that wants to start being a player in this space, and there's someone that is that wants to be an investor in this space, how do you know? Where do you gauge? How do you tell whether this would be the right time, the opportune time? Is it a matter of the maybe bond originator being the one that would tell you, or the guys that know would then be able to advise?
So for us, with regards to how we started the chat, is that there is a blueprint in a sense whereby what guides us, what properties should we be buying. And as Lebo did mention, one of the most key information that tells us that we should be going in is that if we are getting something 70% minus the renovation cost. So this was during COVID. We were still buying. And even till today, if we are finding something, as much as during COVID, the percentage was about 7%, and now we're looking at the interest was at about 7%, and right now you're looking at it at about 10.5. There is an increase, however, we're still buying. So ultimately, you need to understand why are you investing. Once you understand why you're investing, you need to have that blueprint that tells you that this is the type of property that I should be buying. And then in either economic state, you will then alter that strategy in terms of now it makes sense at this point in time. So you might find out that during COVID it wasn't at 70%. Maybe we were saying that we'd buy it at 80% or 75%. So now it's rather than changing that blueprint of yours so that it adapts, because at the end of the day, this is how we eat. So we won't get to a point in time whereby we're saying that we're not investing because the economy is in this state. We still need to eat. So it's just adjusting that formula then.
And also at the same time, it doesn't matter, right? You can buy as many properties as you want. Is there somewhat of a limitation here, or would it be the bank that would say, no, you already have 20 properties in your name? According to the South African law, for instance, can there be somewhat of a limitation to a number of properties that one owns?
No, so the name of the game here is the affordability. So as much as we can afford, we can still buy a property, right? But now this opens up a can of worms, right? If we're looking at the number of properties that we're going to be buying, then we need to start going to CISPET and talk about asset protection and how do we actually buy these properties. Because you find out that some people are buying their properties in their personal name. They've bought 20 properties, but now when they pass on, all of these properties have to be moved from their names into the person that's going to inherit the property. Now you find that person has to pay 18,000 per property in order for them to transfer it into their name. So that's something that we also need to look into, that as much as we can buy, there's no cap in terms of how many properties can we actually buy under our personal name. But now we also need to look at it long term, that if I'm buying all of these properties under my name, how will that affect the person that's going to inherit these properties?
But affordability is the game.
Yeah.
If you are able to afford it, then you can always get a conveyancer, a lawyer, someone that can advise you to say this is how you go about in protecting yourself. But you can buy as many properties and go all out if you want to. How do we, know when it's time to let go?
So for us, what we do, right, is quite interesting, is that we have sort of a spreadsheet whereby we're looking at the performance of each property versus the interest rate currently right now. So then what's happening is that you keep in track in a sense whereby, should I still be keeping it based on how much I'm paying? Now, a lot of people, I tell our clients a lot of times about this, is that a lot of beginner property investors, they're holding on to this property because this was their first property. But to us, it's monopoly. It's a game. That if I'm not making money off this, the question is, why am I still keeping it? As much as, yes, it was my first property, go back to basics. I'm in this for business. And what does business say? Affordability. If there's no affordability, I'm not there.
Another reason to actually sell the property would then be also, I don't think a lot of people talk about this, moving on to a bigger deal.
Yeah.
So for instance, if I've bought this property and I've had it for the past 10 years, I've gained maybe, let's say, appreciation and also equity. Now, if I sell the property and I'm able to actually get out a huge profit and put this down as a deposit to actually get a bigger property that will actually give me more profits, then that could be also something to look into, that if I do sell this property, will I actually get a better investment?
Yeah, but I feel that it's just a matter of knowing where to go in terms of getting all of this information. What are the risks where this space is concerned?
The risk is there. As much as Nirbuaka Upopa Haholo is that
Yeah.
one can make a huge mistake, as we've made a mistake whereby we were about 180,000 minus.
What?
So as much as there's a lot of plus, there is a possibility whereby one can get blacklisted or one can lose that house because they didn't run the numbers correctly. And when looking at your name going down like that, that's going to be with you for probably the rest of your life. So you should know, especially we did mention that there's crowdfunding, there's REITs, those two, it's more easier to get into. But then this one now, you need to understand your story. Man. So, yeah.
Auctioning, does that become a viable option for a first time, a beginner, someone that would want to play in this space and they maybe come across some of these sweet deals? Then the deals would look a little bit too good to be true. But can that be somewhat of a viable alternative or an option, avenue for someone that would want to become a property investor?
You see, with auctions, right? Most people think that auctions are just a place where I can actually grab a property and run with it, right? And we've attended some auctions, and I won't name which auction it is, right? But it was part of the sheriff auction. So what the guys do is that they already have like a click. So they know this week this property has to go to this person. So now they end up inflating prices because, let's say you do not understand at what price should you be buying the property. So somehow they can sense it that this person doesn't know what they're actually doing. So now going into auctions are, you could get a very good deal, you could get a terrible deal. You could get in a deal whereby you see you are the only person that's auctioning. However, when you're supposed to take the property, you have to deal with eviction. We had a situation whereby a client was like, guys, you know what? I bought a property through auction. I haven't lived in that property for the past 2 years. The person that's living there says that this is a family house, and if you want to take me out, you'd have to kill me. So now, your intention wasn't to buy a property to fight with people. Your intention was just to buy a property because you want to go into property investing. Now, if you're getting into such a situation, it becomes tough for you as the buyer or as the property investor. So what I would say is that doing your due diligence in terms of, if you go to an auction, first visit the place. Get a feel of the person that's living in the property. Ask them questions that if you were to actually buy the property, would they have a problem going out of the property? How would, because sometimes the only problem is that the people living in the property don't have money to move their, the things that's in the house to take them kumachai. Now, if you have that conversation before, then at least we know that this is something that we can work with. However, if it's the first time and you've already bought the property through auction and this is your first time going to the property to see it, you might find yourself in a situation whereby you have to deal with evictions. And evictions sometimes aren't good.
Gentlemen, I want us to leave it here for this morning. But please give us a sense of how do we direct people your way? Where do we find you guys? And what's happening?
Okay. On all social media platforms, we are at Nongwealth. So on YouTube, TikTok, Threads,
everywhere,
Instagram, all of them. All of them, bro.
Guys, thank you very much for coming through. And everything of the best in terms of the business, in terms of the space. May you grow. And please come back. Let's keep helping our people out there. I know there are a lot of people that would want to be wealthy. So it becomes the avenue, and if it's possible, then why not? But I really, really appreciate you always just coming through, giving us your time as well.
Much appreciated.
Thank you for the invite.
Awesome, man.